Report, and Liz, if you could do the roll call, please.
Okay, good morning. Mayor's office,
Brian Berge, representing Mayor Eric Adams.
Controller's office,
Allison Hirsch, representing Comptroller Brad Lander.
Public Advocate's office, Borough President of Manhattan, Borough President of Brooklyn, Borough President Bronx,
Robert Maraglia, designee for Vanessa L. Gibson.
Borough President Queens,
Alan Swisher for Queensborough President Donovan Richards.
Borough President Staten Island,
Dan Master representing Staten Island Borough President Vito J. Fasella.
International Brotherhood of Teamsters,
Lawrence Bosley and Ruben Torres for Greg Floyd, President.
Transport Workers Union,
Dave Katzman for TWU Local 100 President Richard Davis.
and District 37. Okay, we have a quorum.
All right, thank you very much, Liz. So actually, unfortunately, don't have the agenda in front of me right this second. Allison, do we have anything on the public agenda today?
We do. We have a quarterly update, but before I hand it to Steve to do a quarterly update, actually, I'll do this at the end because not everyone's here. Steve, go for it.
Thank you and good morning, trustees. Is this on? So I was going to make this brief, but on behalf of David Katzman, I'm actually going to go through every single slide. I apologize if I'm a little less coordinated today than I normally am. I'm just back from COVID, but I'm COVID-free, and I'm glad to be with everyone today. So I'm not contagious. Maybe just take a quick run through the slides. I was joking. It'll only be 15 minutes, but a quick update of where we are in the performance for the third quarter of this year, calendar year. U.S. and global inflation has come down pretty tremendously. Disinflation is certainly taking hold across developed economies. The inflation decrease and the Fed rhetoric is actually causing markets to price in rate cuts beginning in 2024. And that's both in the U.S., the U.K., and Europe as well. Rate hikes are pretty much done, and bond prices are up significantly and yields down significantly. And I'll talk more in detail about the change in yields in a few moments. On the next slide, CPI year over year is just 3.24%, which is great. Remember, in June of 2022, it peaked at 9.1%. You can see on that white upper bar or a mountain peak, but it's come down nicely. Core PCA deflator actually is a little higher, a little stickier at 3.46%, and that's certainly something the Fed continues to focus on. Inflation around the world has come down nicely on the next slide. Europe, actually, inflation has touched 2.5%, and you can see that on that slide in the far right-hand corner. So good developments there here and abroad. On the next slide, employment growth has slowed in line with Fed expectations. The unemployment rate is still below 4%. It was actually 3.7% in November, decreasing down from 3.9% in October. But the Fed's actually pretty comfortable in terms of where we are from an employment standpoint. It does look as though there's an increased potentially likelihood of a soft landing, though I'm still suspicious of that outcome. Wage prices are also still relatively elevated year over year. They're at 4% through last month. But again, the Fed expects those to come down over time. This slide actually indicates where we are from a workforce participation rate. You can see we're still not back to where we were pre-COVID. We're 62.8%, and the unemployment rate way down at the bottom. It's pretty consistent for quite a long period of time since before 2022 at 3.7%-ish. On the next slide, the market fully expects the Fed to continue to witness a decline in the rate of growth on non-farm payrolls. And you can see that the consensus forecast on the far right-hand side, we've seen average growth over the last 3 months of around 180,000 jobs per month. But that is, again, expected to come down in the first quarter of next year. On the next slide, this is great, Wilfredo, sorry. The third quarter U.S. economic growth was a very robust 5%, and U.S. growth has certainly outpaced expectations relative to China. This next slide is a familiar slide, and actually what I'm speaking about there, you can see maybe appropriately, given it's almost Christmas time, where the green and the red lines converge. That's the green on top is China, and the red is the U.S. growth. And you can see on the far right-hand side that they're pretty much where they on top of one another. The expectation is for growth to slow here, and the hope is for growth to pick up in China, but they have some challenges, which I'll talk a little bit more about in a moment. This slide, we see Fed, Bank of England, ECB, and Bank of Japan. Rate cuts are all on hold at this point. Rate hikes, I should say, are all on hold. Expectations that given global disinflation, the next rate changes will be cuts. There is one exception, though. Japan is still maintaining their official rates at a negative 10 basis points. That's been the case. You can see that on the next slide since 2016. The market was expecting this week for the Bank of Japan to actually increase rates, to bring them something above a negative 10 basis points, and they failed to do so. They disappointed the market, and certainly the currency reflected that as well. On the next slide, November and now month-to-date December, bond prices have increased and yields have come down pretty dramatically. Credit spreads in the U.S., investment-grade and high-yield corporate debt have tightened, mostly on retail and insurance company inflows or market technicals. And there's been a huge investor interest in private credit, which I think is positive. A lot of that stemming from the disruptions we saw in the regional banks in the second quarter of this year, and an unwillingness or inability for those banks to continue to extend credit, and the private markets are picking up the slack. This next slide, I wasn't really going to talk about the next slide, but there's an interesting statistic I'll share with everyone, or fact I'll share with everyone today. 2023 calendar year started with 10-year U.S. Treasury yields at 3.88%. Where are they today? They're 3.88%. However, the range has been really dramatic. We had a rally in the early part of the year, driving yields down in 10-year Treasuries to 3.30. And a backup all the way to 4.99, or I actually saw it trade at 5.01 intraday. But again, now it's at 3.88%. So it's a lot of volatility, and it's just a tremendous rally in Treasury bond prices and a decline in yields. On the next slide, and this is hitting a moving target. Dan Haas puts these slides together for myself and the team. Does an excellent job. Every time he puts these slides together with 2- and 10-year yields, they change. So on top, you see in white, 4.39. 2-year Treasury yields are at 4.24 today. As I mentioned earlier, 10-year yields are not 3.92, they're at 3.88 this morning. So again, a huge decrease in U.S. Treasury yields since the end of October. And again, that's with the slowdown in the economy, some change in Fed rhetoric at the last meeting. I should also note that 30-year U.S. mortgages rates are now at the lowest they've been since June. So hopefully that'll help provide some underpinnings for the property markets in the States. On the next slide, I mentioned credit spreads have tightened. Again, another moving target. These have come in since this chart was developed. Investment grade and high yield corporate spreads have declined. You can see on top in orange, the 363, those are high yield spreads relative to comparable U.S. Treasuries, maturities, and investment grade at just 101 basis points. These are really compelling levels. But again, they were compelling at one point and attracted a lot of retail flows into those ETFs and those funds. On the next slide, since early November, stock and bond prices have surged. And for the month of November, the public market 60/40 portfolio, which is oftentimes referred to, has delivered a 7.6% return in 1 month. And it's been quoted as being a great year for the month of November. The 60/40 portfolio overall year to date for the full calendar year has generated about an 11% return. So public market securities have rebounded and performed fairly well this year. On the next slide, a look at, unfortunately, third quarter. The references I'm making right now around the rally really talk to November and the first half of December. October was pretty challenging, as was the whole third quarter. And you can see that's evident in the third quarter 2023 results, where both equities and fixed income markets in the public sector all traded off. The one exception is high yield, and high yield had benefited from wider credit spreads that were coming in a little bit, High yields, that index also has half the duration because the coupons are much higher, has half the duration of the investment grade corporate index. So again, when bonds were selling off and prices were moving lower, yields higher, it certainly benefited the high yield sector, which is a steady performer. On the next slide, I'll look at world equity markets. The Russell 3000, not really pictured here, but I wanted to reference it. Year to date is up fully 18%. European stocks are also higher. You can see that in the belly of that slide on the far right-hand side, up anywhere between starting in Euro Stock Index at 14%, the FTSE up, 22% for the Euro Stock Index, FTSE up 8% all the way down the list, all up, all positive and in double digits. Japanese stocks have been up 25% year to date. You can see that on the lower part under Asia Pacific Nikkei. The index is up 25%, but when you convert those yen back into dollars, because the yen is weakened relative to the dollars, it's only up 15%. Or another way of looking at that is that Japanese yen has declined 10% versus the US dollar. And the last note on here is on the bottom of the page, you can see the global Bloomberg World Index. That covers about 85% of global stocks. And year to date up fully 17%, almost 18%. So a good rebound in global stocks as well. On the next slide, I'll look at world bond markets. Sovereign yields, as I mentioned, U.S. Treasury 10-year yields had a range of technically 330 to 499. I like to call it 5%. Again, they were 388% right where they started the year. But we've also seen sovereign yields in Europe lower year to date, again, given the recovery, well, the challenges in the market there, but in recent recovery. On the next slide, just a quick look on the right-hand side, you can see that's the Bloomberg Ag, or the Bloomberg Aggregate. You can see there's some volatility, but a nice recovery. And on the left-hand side, you can see the three major stock markets, U.S., developed market, ex-U.S., and emerging, all recovering nicely. In recent news, on the next slide, the Chinese economy, as I reflected to earlier, has been challenged really by poor property markets and some other issues. The shadow banking system there is struggling. There's anywhere between $7 and $11 trillion of off-balance sheet or non-bank debt that's concerning the markets there and the regulators at this point. Moody's actually placed China's sovereign rating on negative credit watch earlier this month. A couple other things of note: Sam Bankman-Fried of FTX infamy is heading to prison. He was found guilty on all charges. And we've had some drama, which Larry and I were talking about earlier, around the OpenAI leadership team, where Sam Altman is back in the seat. Food for thought on the next slide. Yeah, there we go. This is just a reminder that asset class bubbles in specific sectors and themes do occur over time. This looks back to the 1977 period up through June of this year. And you can see that there have been bubbles that have developed in gold and Japanese stocks, Russian stocks, technology, and the latter part of the internet craze of 1999 to 2001. Oil prices, Bitcoin at one point in red, you can see spike. I'd say the other thing to note, however, is artificial intelligence. It does appear that the valuations have got ahead of themselves, and that's the far right-hand side, that, I don't know what color, aqua blue color. It does seem as though valuations have gotten a little bit ahead of themselves. Let me now slip to the next slide. This actually looks at the Magnificent Seven stocks. They've really dominated the S&P 500 performance in 2023. So it's really been the Magnificent Seven and the other 493 stocks that haven't really contributed much in the way of return. As a reminder, the Magnificent Seven stocks are Apple, Microsoft, NVIDIA, Amazon, Meta or Facebook, Tesla, and Alphabet or Google. And in every way, all seven of these have a significant presence and certainly touch artificial intelligence. And that may be an example that there's a little bit of a bubble developing, but it may also speak to the fact that we do believe that artificial intelligence will be a transformational technology that will have significant impacts on how we work and where we work and the productivity we're able to deliver as individuals and companies in our economy. On the next slide, a couple other notes. Again, Food for thought, the default cycle has started. You can see in the far right-hand side, that dotted line, we've seen default rates in unsecured loans and high yield moving up in the past 24-ish months. Not at levels that are really a matter of concern, but certainly something that bears watching. Similarly, on the next slide, you can look at credit card delinquencies. They're also rising on the far right-hand side, again, coming off of the COVID lows and the amount of money people have built up in their portfolios and checkbooks. But you can see that's a disturbing trend. In the same vein, next slide, auto loans are also seeing serious delinquencies increase. Those are loans that are 90 days behind payment or 3 months behind payment. Moving up, and actually to levels not seen since 2008. So we'll see how that continues to bear out on consumer confidence, consumer demand, and economic growth. Pardon me. Similarly, on the next slide, and I don't mean to be so down on things because I'm generally an optimistic person. But on the far right-hand side, you can see that there's been a rapid decline in bank lending. Again, a lot of this has to do with the regional bank challenges we saw in the second quarter, March, April, and early into May, where small businesses have had to seek alternative sources of funding. And the good news is that the private credit market and non-traditional bank lenders have stepped in to fill some of that void.
Just to be clear, Steve, this slide is showing the year-over-year growth in bank lending rather than the absolute level. Is that right?
Yes, yeah, and you can see that on the far right-hand side, it's actually been negative growth. So again, and it really kind of trails up pretty significantly from the middle part of this year, which is, again, a disturbing trend. I think on the next slide, you look at, this is just another food for thought. So I try to get a sense for, everyone talks about the buildup in private assets and how disconcerting that is and how dramatic it is. So this is actually a 10-year slide that looks at the increase in public and private markets since 2013. On the far left-hand side, you can see that we've seen a growth in global fixed income markets by about $42 trillion in 10 years. That's currently at a total of about 136 trillion, which represents about a 44% increase, again, over the last 10 years. Equity markets next has seen an increase of about 35 trillion to a new base of about a total $110 trillion around the world. That's an increase of fully 46%. And lastly, I really didn't have great statistics on bank balance sheets, so I apologize for that. On the far right-hand side, you can see the increase in private capital assets under management have increased about $8 trillion over the last 10 years. That's to a new base of about 40 trillion, which is an increase of just 25%. Still, it's a substantial increase, but again, relative to the global bond market, up 44%, and the global public equity markets up 46%, 25% doesn't seem that overwhelming. On the next slide, again, more food for thought. Bond investors at some point will focus more on fiscal versus macro developments. We saw a little bit of that in October, November. Right now, the focus is on the decline in inflation and the slowing of the U.S. economy in particular. This slide actually looks at the holdings of China in U.S. Treasury debt. So you can read the headline up top. China is holding $300 billion less than they were in 2021. And it raises questions about who's going to be the marginal buyer of our debt going forward. The U.S. debt issuance, given the amount of deficits we've been running on a federal and fiscal basis, U.S. average auction sizes in 2024 are expected to increase by 24%. So a lot more issuance coming, and there's a lot of eyes that are on the 20-year treasury note or bond auctions today, and I think that will become an increasing focus for the markets. Again, the marginal buyers had traditionally been non-U.S. bank and central bankers. China and Japan were the two leaders. China, you can see by this chart, is slowing down their purchases and holdings, as is Japan, more because of the costs associated with the currency hedge. But again, something that bears watching. On the next slide, maybe talk a little bit more about China. Chinese consumer confidence is very low, and you can see on the far right-hand side, it's really dropped off quite significantly from 2022 into 2023. A little bit of a rebound earlier this year, but again, has come off from that. This is constraining growth in the world's #2 economy and will dampen and potentially slow global economic growth if it persists. Certainly having that effect now, but if it persists. Maybe shift over to 2 slides forward. Wilfredo, thank you. Just a couple slides that Dan Haas has pulled together. We're trying to change the way we present performance. This actually looks at performance for the third quarter of this year through September 30. Third calendar quarter, it's actually the end of the first fiscal quarter for 2024. And here we're looking at trying to achieve a 7% actually assumed rate of return. And you can see we disappointed. In the 3 months, that quarter, all returns were negative. The NYCERS total plan was down 2.2%, which includes private assets as well. But again, that's to be expected given the challenges we saw in the public markets. On the next slide, a look at, again, that 7% actually assumed rate of return. Wilfredo, next slide. There we go. That black line is what we're trying to achieve. So this actually looks at the portfolio value relative to that 7% return target over time. And you can see that we're certainly off of where we were at the lows of 2022. Rebounded nicely. We had a sell-off in the third quarter of this year. Again, I'm happy to report for the fourth quarter to date, the market has been much more friendly and robust, and those returns have actually come back nicely. On the next slide, a look at public market returns by strategy as of the end of September. NYCERS net returns by strategy are reflected here. You can see a couple of outliers. I suggested that high yield has been an outperformer because of its relatively low duration and tightening of credit spreads, which has powered the yield a little bit to provide at least some green on the screen for that quarterly update. Also, cash, those at 1.5% is the 90-day return over a year. So basically, if you multiply that by 4, that's give you a sense for about where we're going to wind up in terms of annual returns from cash, and 5.5%. But you can see all other manner of public markets have underperformed. The particularly most challenged area has been fixed income, core fixed income, 3%. Developed market ex-US equities down almost 7%. So again, not a great quarter, but again, a nice rebound we've seen this current quarter. On the next slide, developed world ex-US performance has been underperforming for the 3 months in terms of excess return relative to the benchmarks. That's because of 2 of the active managers have actually underperformed their benchmarks, which are still, the benchmark's down 4%, but those 2 managers were off significantly more than that. And again, that's to be expected with highly concentrated fundamental managers. On the bottom of the chart, you can see total NYCERS policy benchmark is off 53 basis points under where it would have been, again, dragged down by world ex-US as well. On the next slide, perhaps a more positive slide. This is the net private manager returns by strategy through the end of the quarter, the third quarter. NYCERS net private market returns have been generally positive. The one outlier here is core private real estate. Again, that has to do with the mark-to-markets, down 8.9% for the year. These are 1-year net returns from the period of June 22nd through June 23 of this year marks. So again, I think if you focus more on the far right-hand side, and the 10-year returns in particular have been quite strong. On the next slide, just a look at 1-year excess returns, and this might shock some people, and you can look up top. The one outlier is private equity, which has been certainly a star for the portfolios consistently over time. I don't necessarily think this is a great story, but it's not a bad story either. This really has more to do with the fact that these are June 22nd, June 2022 through June 23 period marks. The private equity portfolio, your private equity portfolio, has returned about 5.8%. Versus the Russell 3000, again, coming off of its challenges in 2022, is up fully 18.9% for this period. So again, positive return versus positive return, but underperformance relative to that public market equivalent, that Russell 3000. I think, again, if you look at 10-year, the excess returns across all private market assets have been quite healthy. And the last slide for public session is just a look at our rebalancing activities. And here we were simply selling large and mid-cap stocks to raise cash to meet benefit payments and capital calls for private markets. Excuse me. And with that, I'll open up to any questions. Sure, Larry.
One quick question. You mentioned that the bank lending declined. You had some concerns about that, but isn't that being taken up by the private lending industry growing and filling that void?
It absolutely is. The only concern that I would have, I'd say, and that the market has, is that the ability for small businesses to actually tap into those private market, private credit opportunities, where the traditional lenders, I believe, I showed a slide a couple of quarters ago, I think it was 70-80% of small businesses get their funding from local banks. So that may be a constraint for small and local banks. But there are a lot of other networks that are popping up where you can find funding through non-bank sources.
Let me just add to that, that in the regular banking market, there are regulations and oversights on such matters as discrimination, which is much fuzzier in private lending.
Yeah, yep, yep. Any further questions? Great, thank you.
Before we go into executive, take a motion to go into executive session, I just want to state for the record that we've been joined by Manhattan Borough President designee Keisha Sutton-James.
All right, so does that conclude public session?
It does.
Okay, is there a motion to go into executive session to discuss investment matters?
So moved.
Thank you very much, Mr. Katzman. Is there a second?
Second.
Thank you very much, Mr. Bosley. All in favor of that motion, please say aye.
Aye.
Any opposed? Thank you very much. Those online. Any opposed or abstentions? Hearing none, the motion carries unanimously, and we will go into executive session.
The board took action on an alternative credit and private equity matter today, the details of which will be disclosed at a later date.
All right, thank you very much, Liz. And I believe we have one more item for the public session today, and I will turn over the floor to Ms. Hirsch. For those of us who cannot see in the room or on Zoom, she has an attractive framed item, which she will now describe.
So as many of you know, today is the last investment committee meeting and NYCERS meeting writ large of Brother Katzman. And he has been a leader on this board for, I don't know, before my time, but I think it might say on the accommodation. But I just wanted to say on behalf of Controller Lander, and I know John Dorsa and John Adler both, John Adler's in the room, woohoo, perfect timing, yay, got here just in time. The leadership you've provided this board is really, we are all very grateful for that, and we will miss you terribly. And I will read the accommodation, and then if any other members, I know that you all did this a little bit last week and I wasn't there, but I'm gonna do it. So we're doing it again. Sorry, Dave. And I know what you've always wanted is a very large framed accommodation for your home wall, but I will read it. City of New York Office of the Comptroller Accommodation presented to David Katzman for over a decade of service to the New York City Employees Retirement System, for his dedication to the labor movement as exemplified through steadfast service at the Transport Workers Union Local 100, for inspiring fellow trustees, for outstanding contributions to the lives of members, beneficiaries, and retirees of the City of New York, through diligent oversight of the assets of the New York City Employees Retirement System, for the intelligence, wit, and candor he brings to his role as trustee, for his devotion to the pursuit of knowledge that has earned him the respect and admiration of his peers, for his calming nature and kind demeanor, for gaining the trust, appreciation, and gratitude of his colleagues, and for his tremendous contributions to the City of New York. Signed, Brad Lander, Comptroller. So.
Well, I would like to thank the controller. I would like to thank my fellow trustees for their kind remarks last week. And I would just like to say that leaving will be hard. I will miss the work. I will miss the pleasure of your company. And I will miss the honor of associating with people who take their fiduciary responsibilities seriously. Thank you.
So I know we did indeed amply discuss the many accomplishments of Mr. Katzman at our most recent meeting, but you can never say too much. So I now open up the floor for anyone else who would like to discuss this topic. Oh, Mr. Adler.
Mr. Adler.
Point of privilege for
Point of
Mr.
privilege
Adler.
for our prior trustee.
Point of privilege. Thank you so much. Listen, I liked working with all the trustees I worked with when I was a trustee back in the day. But I have to say, I really loved working with Dave Katzman. He is the person with as much integrity as anybody I ever dealt with in over 20 years of working with public pension funds and public pension fund boards. He was, now I'm talking about integrity, and now I want to say he was a wonderful partner in scheming to get good things done. And he knows what I mean, but we were often thought partners. He was a thought partner to me, let me put it that way, in trying to figure out how to get stuff done at NYCERS, somewhat on the investment side, truthfully, when I worked not on the 8th floor, but on the 5th floor in this building. But also at NYCERS itself, and trying to get good things done for the members and beneficiaries of NYCERS. Dave was really creative and is creative, and just brings so much, like I said, integrity and commitment to his work as a trustee. And I know, honestly, it would be very difficult to replace him on this board, even though this board is filled with really, really able trustees and folks that are committed. But Katzman played a unique role. And I know I will miss him, and I think the members and the beneficiaries of NYCERS will miss his presence on this board. Thanks, Dave.
All right, well said, Mr. Adler. Well, I mean, I'm sorry to, oh, there's another announcement.
It's just a very quick housekeeping announcement, which is January's investment committee meeting is actually going to be physically at the NYCERS building, not in Brooklyn, not here, because Mikey, who never gets acknowledged in the back, who runs all of the tech for this entire building, is finally getting to go on vacation. And we can't do anything in this room without him, and he has earned his vacation. So we will be in January meeting at NYCERS in Brooklyn
For the investment meeting.
for the investment meeting.
If I may jump in on Mr. Katzman's departure.
Certainly. I was trying to keep the floor open for those of us who had not set our fill on this subject.
Well, I wasn't, unfortunately, I had 1,000,001 things. I was not at the meeting where this news was announced, so this just came as a major shock to me. I almost felt a tear roll down my face, Mr. Katzman. I'll just say, I've only been on the board for 2 years, but you have clearly stood out as someone whose breadth and depth of knowledge definitely reflects the commitment that you just referred to, John Adler. There doesn't seem to be anything, any technicality, any detail of any of the work that NYCERS does, whether on the investment side or the management side, the historical, anything, doesn't seem to be any detail that you have not stored somewhere in your brain somehow. And so I don't know how you do it, but I appreciate the fact that you do it, because you have brought so much knowledge, historical, institutional knowledge to every one of our meetings. And you will be sorely missed. by this trustee or designee. Thank you.
I did want to say, Dave, that though the large frame budget has suffered under the peg, I wanted to convey that Mayor Adams likewise appreciates your service, and I can do so on the basis of my efforts to secure a large frame. I nonetheless can convey his deep respect for your work at this board.
And that's ditto for Local 237.
And I will say that Larry and I have spoken, and we're going to do our very best to raise our game to somehow make up for Dave's absence. It's aspirational, but I'm up to the challenge.
You can tap into your innermost reserves of strength. All right, so I believe that now concludes the public session. Is there a motion to adjourn?
So moved.
So moved by Mr. Katzman. Is there a second?
Second.
Mr. Bosley, thank you. All in favor, please say aye.
Aye.
Any opposed or abstentions? Hearing none, the motion carries, and we are adjourned.
And lunch is served, I believe.